The $5 million daily burn. Strategy Incorporated is currently paying out $4.7 million in dividends every 24 hours just to service its preferred shares. This massive capital obligation is the direct result of the Strategy Treasury Redeemable Convertible Program issued late last year. While Michael Saylor once promised to never sell a single Satoshi, the math of an 11.5% dividend is now colliding with a stagnant Bitcoin price. For the first time in the history of the world's largest corporate treasury, the internal flywheel is spinning in reverse. The STRC yield trap. To understand the crisis, you have to look at the mechanics of the STRC instrument, often called digital credit. Unlike the old convertible notes that didn't pay interest for years, STRC was designed as a high-yield preferred stock with a variable monthly dividend currently sitting at 11.5%. It was a masterstroke for attracting institutional liquidity when Bitcoin was at $90,000, allowing Strategy to raise over $13 billion in record time. But because these dividends are paid in cash and must be adjusted to keep the shares at their $100 par value, they have become a fixed operational cost that does not care about market volatility. In a sideways market, this yield is not a bonus. It is a structural leak in the treasury. The death of the flywheel. Negative reflexivity occurs when a falling stock price makes the cost of capital so high that the company must sell its core assets just to stay solvent. Because the Strategy premium over net asset value has collapsed to its lowest level in 2 years, issuing more common stock is no longer an option for Michael Saylor. He is stuck with the dividend, the first great treasury sale. The most shocking development came just 2 days ago during an interview where Michael Saylor admitted a Bitcoin sale is now not unlikely. This is a total reversal of the 7-year accumulation narrative. The strategy has shifted from maximize Bitcoin at all costs to maximize Bitcoin per share, a subtle linguistic pivot that allows the company to offload coins to fund dividend obligations. Think of it like a landlord being forced to sell off the individual apartments in a building to pay the mortgage on the whole block. With the June 15th dividend deadline approaching, on-chain analysts are already flagging large movements from the oldest Strategy wallets toward exchange deposit addresses. This is no longer a theoretical risk. The company reported a $12 billion net loss in the first quarter of 2026, and the pressure to defend the credit rating of their preferred shares is finally outweighing the ideological commitment to holding forever. The real implication. The Strategy dividend crisis reveals that the institutionalization of Bitcoin has fundamentally changed the asset's floor price mechanics. We are seeing the endgame of the STRC yield trap, where the very credit instruments used to fuel the 2025 bull run are now acting as a ceiling on the current market. By transforming a digital commodity into a multi-tiered capital structure with 11.5% fixed obligations, Michael Saylor has effectively tethered the Bitcoin price to his own company's solvency. For investors, this means the historical conviction of the world's largest whale is now secondary to his monthly cash flow requirements. If Strategy is forced to sell to maintain its dividend, it creates a programmatic sell wall that could take months to exhaust. The days of treating MicroStrategy as a simple Bitcoin proxy are over. It is now a complex debt machine that must eat its own tail to survive. The specific indicator to watch is the total market cap of the STRC shares relative to the Treasury's liquid cash reserves. If that ratio continues to widen before the next quarterly report, the first major liquidation is a mathematical certainty. Subscribe for more.